The market sentiment toward the Japanese yen is overwhelmingly bearish, with the currency pinned near 40-year lows around 162 against the dollar. Major institutions like Goldman Sachs and Societe Generale are forecasting further weakness, and carry trades continue to pressure the yen despite growing intervention risks. Watch for the biggest risk, which is a disorderly yen sell-off that triggers financial contagion, particularly through Japan's large holdings of US treasuries. If you're wondering, why am I covering Japanese yen today? What has that to do with US market? Well, here you go. Japan's large holdings of US treasuries. Unwinding of these positions could spike global bond yields and create a feedback loop of further currency weakness and market instability. The Bank of Japan potentially shifting policy toward higher yields represents the most significant opportunity, as any hawkish pivot could trigger a major reversal in yen trends and benefit yen-denominated assets. Additionally, the yen's perceived undervaluation of up to 20% creates a long-term buying opportunity for patient capital. Monitor Bank of Japan policy signals closely for any shift away from ultra-loose monetary policy. Consider hedging USD JPY exposure given the bearish consensus, while maintaining watch for intervention triggers at the 162 to 165 range. Avoid adding to unhedged yen positions until a clear policy pivot or valuation floor is established. Top headlines: yen pinned near 40-year lows as intervention risks mount. This is the dominant narrative across financial media on July 6, 2026. Multiple outlets report that the yen is testing or near the 162 level, which represents a 40-year low. The persistence of this weakness suggests market participants are testing the Bank of Japan's resolve, while carry trades remain profitable. Options market flashes bearish yen signal as Tokyo stays sidelined. Options pricing is a leading indicator of market sentiment. The bearish signal suggests professional traders are positioning for further yen declines. Tokyo's inaction is notable given Japan's history of intervention, and its absence emboldens sellers. Bloomberg reports that options markets are signaling bearish sentiment on the yen. The Bank of Japan has refrained from intervening despite the currency slide, which traders interpret as implicit tolerance for further weakness. Societe Generale warns of new yen lows against dollar. This adds to the chorus of bearish forecasts from major financial institutions. Societe Generale's warning carries weight as a major currency trading bank, reinforcing the view that yen weakness is structural rather than cyclical. Goldman Sachs cuts yen forecast to 165 per dollar. This forecast from a major investment bank signals institutional conviction that yen weakness has further to run. The 165 target is significantly below current levels around 162, implying an additional 2% depreciation. Goldman's endorsement of carry trades also encourages the very flows that are pressuring the yen lower. Carry trade demand counters yen intervention risks. Carry trades are the mechanical engine behind yen weakness. As long as the Bank of Japan keeps rates low and the Fed maintains higher rates, the incentive to short the yen remains powerful. The structural factor may persist regardless of verbal intervention from Tokyo. Yen at 40-year low becomes America's bond market problem. Remember what I said? How does it matter to American markets? There it is. Business Insider highlights that Japan's yen weakness is creating spillover risks for US bond markets. As Japanese investors repatriate funds or hedge currency risk, it could lead to selling of US treasuries, potentially pushing yields higher. Japan spent $74 billion propping up yen, but battle is with Fed. This underscores the limits of unilateral intervention, absent coordinated action or a shift in Fed policy. Japan's reserves may prove insufficient to reverse the trend. The $74 billion figure also highlights the fiscal cost of defensive currency operations. Emergent signals: former currency czar claims yen undervalued by up to 20%. While near-term momentum is bearish, this signal identifies medium-term opportunity. The yen is significantly undervalued on a purchasing power parity basis. Patient capital could profit from eventual normalization. The former official statement also reinforces the case for eventual policy action from Tokyo. Bitcoin rally linked to yen carry trade dynamics. By the way, if you're wondering, why did Bitcoin actually jump from 58,000 to 63,000? Yeah, right now it's a little in red, but this is one of the reasons. This signal connects yen depreciation to the cryptocurrency market. If the carry trade narrative strengthens, Bitcoin and other digital assets could see increased inflows as investors search for higher returns outside traditional fiat currency pairs. This represents a cross-asset opportunity for crypto-exposed funds and traders. Last but not the least, what's the biggest risk here for US dollar? Japanese investors, in response to the yen's weakness, may sell their holdings of US treasuries. Business Insider specifically reports that as Japanese investors repatriate funds or hedge currency risk, it could lead to selling of US treasuries, potentially pushing yields. This would create a disruptive spillover effect in America's bond market, increasing treasury yields and causing broader financial instability, including the stock market. Ladies and gents, this is all I have in the Greed Report today. If you like what you see, subscribe, and I'll see you in the next video.